Hello friends, welcome to CMA Academy. In the continuation of our last video, as we were discuss about the computation and meaning of the book profit as per the explanation 1 of section 115 JB, and this section is related to math, that how to calculate book profit for the computation of math profit. In the last video we discussed about the increased uh, things, that the provisions should be increased in the profit of the profit and loss account, so that we will reach at the book profit. In the continuation with this portion, we will discuss in this video about the reduced provisions, those items which should be reduced from the profit and loss account, like the expenditure which are allowed as deduction, but that is not debited in the profit and loss account, and the incomes which is not related to PGBP, but it add in the profit and loss account, and it should be reduced from the profit of PGBP, so that we will calculate the MAT profit. Let's continue with the reduced points. In the first point, the amount of withdrawn from any reserve or provision, if any amount, is credited to the statement of profit and loss account. That means if any amount withdrawn from any reserve or provision, and that is credited in the profit and loss account. Credited in profit and loss account means that amount is increased our current year profit. This is actually wrong. If we made any provision in the past and now we withdraw any amount from that reserve or provision, and that is credited in our profit and loss account, it should not be our current year profit, so it should be reduced from our current year profit. But the one provision is related with this clause, that if the provision or reserve is created before 1st April 1997, if the reserve is created before 1st April 1997, so the amount of withdrawn shall not be reduced from the current year profit, but the reserve or provisions is made after 1st April 1997, it should be reduced from the current year profit. Next is the amount of income to which any of the provision of section 10, 11, 12 apply, if any such amount is credited to the statement of profit and loss. That means these three sections are related to exempt income. As we discussed in the last video also, that the section 10, 11 and 12 are the exempt income sections, but except two sections we discussed in the last video also, that section 10 subsection 38, that is related to long term capital gain, and section 10 AA, that is related to SEZ income. These two sections are no, these two incomes, if are credited in the profit and loss account, that should not be reduced from the profit, because on long term capital gain and on SEZ income, the MAT is applicable. Next point is that the share of profit of AOP, if such share is exempt under section 86. In the section of 86, that if we in gain if we gain any share from AOP, and that and the if and the tax is already paid by AOP, so that income is exempt in the hand of the taxpayer. So if that income is credited in its P&L account, it should be reduced from that account, because the tax is already paid by the AOP, and it should not be taxable in the hands of the taxpayer. Next is the foreign company. Those income related to the foreign company, the two types of income. The first is capital gain arising on transactions of securities. The tax rate on the capital gain arising on transactions in securities for the foreign company is 5%. So the MAT is not applicable on that income. If any income is credited as capital gain in the profit and loss account, it should be reduced from the profit and loss account. Similarly, if any amount as received as interest, royalty or fees for technical services which is chargeable to tax under section 115A to 115 BBE. In the last video we also discussed at this point that these the sections there the income is chargeable at different rates, and if that income is chargeable less than 18.5%, so that the MAT provision is not applicable on that companies on that income. If the income is taxable more than 18.5%, then the MAT is applicable. The next point is the amount representing as notional gain on transfer of capital asset being share of special purpose vehicle to a business trust in exchange of units allotted by that trust referred to section 47 17, or notional gain resulting from any change in carrying amount of said units, and gain on transfer of units referred in section 47 subsection 17. As we discussed in our last video also, that the section 47 is referred that to capital gain. In this section, the items referred that is not treated as transfer, and the items is not treated as transfer, then capital gain is not arise on that income. So if any income or notional gain arise from the transfer of the units of or special purpose vehicles to business trust, that is referred in section 47 subsection 17. So the in that on that income uh, prof no taxes chargeable. That's why we reduce that income from our profit to the calculation of MAT provisions. In the next point, it is right that the amount of loss on transfer. In our last video, we saw a point of reduce. It is the last point in the increase of profit, that the gain on transfer of preferred section 47. In last video, I also discussed this point that it should be reduced from the profit, not should be increased. So I think it is a printing mistake in this, that the gain point is written typed in the increase point, and the loss point is added in the reduce point. It should be add it should be increase if loss is if loss is debited in the profit and loss account, it should be add back from that in the profit. It should not be allowed as deduction. And similarly, if any gain credited in the profit and loss account, it should be reduced from the profit and loss account, from the profit of the current year. This is also related. This section is all. This point is also related to the units referred in 47 subsection 17. In this point, that by taking exchange of shares, but in the above point, it is related to the business trust or special vehicle purposes. In this point, it is referred to units that are covered under section 47 subsection 17 other than business trust. But the concept is same, that section 47 is related to the item which is not treated as transfer, and the capital gain is not arise on that income. So if any loss arise from that unit, it should not be allowed as deduction. And if any gain received from that unit, it is not also is a part of the profit. Then if any gain is received, it should be reduced. And if any loss arise from that from the units, and that should be add back in the profit. The amount of income by way of royalty in respect of patent chargeable to tax under section 115 BBF. This section is for introduced for the copyrights or patents. Any royalty income received in respect of patent, that is it should be chargeable under section 115 BBF. That means that MAT provisions is not applicable in on this income. And because in this section the special rate is taxable, that is at the rate of 10%. So if any income arising from the royalty in respect of patent chargeable to tax under section 15 BBF, it should be taxed at the rate of 10%. Then MAT provision is not applicable in that income. If any income is credited by the royalty, it should be add back in the it should be reduced from the current year profit. Next point is the amount of depreciation debited to the statement of profit and loss account, excluding the depreciation of revaluation of assets. It means that on depreciation that is debited in the statement of profit and loss account, means depreciation as per uh, books of accounts, as per the books of accounts is allowable as deduction, not as per the income tax. But as per the books of accounts means we also call that the Companies Act account, because we maintain our books as per Companies Act. So as per Companies Act, the depreciation is allowed, and that is debited in our books of accounts. It shall be reduced from the profit of the current year, but it excluding the depreciation of revaluation of assets. Means any amount that if our that means any amount in the revaluation, that means our asset revaluation is higher than our historical cost, and the depreciation is also allowable on the higher value of higher value. So in the books of accounts, we debited that the depreciation of revaluation of account asset. But in the MAT provision is not allow us to revalue any asset or depreciate any asset or on the revaluation amount. So that we only debited the depreciation amount that is applicable as per the books of accounts, but it should not be include the depreciation amount that is on the revaluation of assets. Next is the amount of withdraw from revaluation reserve and credited to the statement of profit and loss account does not the amount of depreciation on account of revaluation of assets referred above. That means if we revalue any asset, and the amount is and the amount is higher of that asset from our historical cost, and the amount and the differential amount we credited in our profit and loss account and transferred that amount into the revaluation reserve account. So MAT provision is not allowed as to any revaluation of assets if any amount is credited to the statement of profit and loss account. It should be reduced from the current year profit. Next point is the amount of brought forward loss or unabsorbed depreciation. whichever is less as per the books of accounts. uh, that means if any amount is brought forward as loss, or any unabsorbed depreciation is due, and the amount so MAT allow us to take deduction the lower amount of as per the books of accounts, the lower amount of unabsorbed depreciation, or here the word is or, not the and. So if the amount of brought forward loss or unabsorbed depreciation, whichever is lower as per the books of accounts, we take as deduction. But the uh, provision explanation is provided in this section also, that the loss should not include depreciation. Means the only unabsorbed depreciation we will reduce, not the depreciation, because depreciation is already covered in the above point now. So depreciate no, this amount this point is not considered, not include the depreciation point. It is only talking about the unabsorbed depreciation. Then the second explanation is that the provision of this clause shall not apply if the amount of brought forward loss or unabsorbed depreciation is nil. That means, uh, for example, uh, in year 1, 2, 3, the brought forward loss is 3, 5, 2, and unabsorbed depreciation is 2, 5. Means let's that means 251. Okay, so the total amount is 810, and here is 8. So as per this provision, we will take the deduction of lower of any of those, that its total is 10 and its unabsorbed depreciation total is 8. So we will take the deduction of 8, not for the 10. If this, if the unabsorbed depreciation value is nil, so we cannot take the deduction of 10, because this provision is shall not apply if any amount of loss of brought forward or unabsorbed is nil. If the unabsorbed depreciation value is nil, so the brought forward loss shall be continue as brought forward in next year. It should not be allowed as deduction. Similarly, if brought forward loss is nil, then the unabsorbed depreciation is not allowed as deduction. It also be it also carried forward in the next year. The exceptions are given in this point. This is very important point, and it is also an amendment point. Okay, in the case of company against whom an application of corporate insolvency resolution process, we know about the insolvency bankruptcy code that is applicable in 2016. So those companies or corporates which are under the IRP, so by the adjudicating authority under insolvency and bankruptcy code, the aggregate, not lower. It is very important point that the aggregate, not lower amount. I hope it is visible. Okay, sorry. Aggregate, not lower amount. Amount of unabsorbed depreciation and brought forward loss shall be reduced while computing the book profit. That means if any company uh, is under the process of IRP, insolvency resolution processing is going on on that company, and by the adjudicating authority under the IBC code. Okay, so for that company, the aggregate of brought forward loss, and here the word is and, means both, unabsorbed depreciation and brought forward loss shall be reduced. Uh, total of unabsorbed depreciation and brought forward loss, both shall be reduced. That means both shall be allowed as deduction while computing the book profit. Next point is the amount of deferred tax. Any amount credited in the statement of P&L account, it should be reduced from the current year profit, because deferred tax is not allowed as deduction, and deferred tax is not allowed as credited in the profit and loss account. Next is the amount of profit of sick industrial company for the assessment year commencing on and from the assessment year relevant to the previous year in which the said company has become sick industrial company, and ending with the assessment year during the entire net worth of such company becomes equal to or exceed the accumulated loss. Net worth means paid up capital plus free reserve. That means if any company is declared as sick company in the current assessment year or in the previous assessment year, and the company earn any profit uh, with any profit that is equals to the its net entire worth of such company becomes equals to or exceed the accumulated losses. That means profit means exceedation of excess of the accumulated losses, or the if the company earned the profit that is equals to the net profit of such company. In the context of this provision, net worth means that the paid up capital and free reserve. If a company which is declared as sick company and it earns a profit that is equals to or exceed its accumulated losses, so that profit is should not be added in the calculation of book profit for the MAT calculations. It should be reduced from the profit and loss account. So friends, the MAT explanation one is over here, and we will discuss the two illustrations so that the MAT provisions should be clear to you. So the first illustration is illustration 5, that is Apple Industry Limited provides the following information for the financial year 2018-19. Net profit of the profit and loss after debiting or crediting of the following. Net profit is 120 lakhs. In these items is reduced debiting and crediting in this profit. Proposed dividend 30 lakhs. We discussed in the last video that proposed dividend should be add back in the uh, our current year profit. It should not be allowed as deduction. Profit from unit established in SEZ. In the SEZ, we discussed the SEZ income or expenditure. The MAT provision is applicable on SEZ. As per income tax, SEZ income is exempt, but as per MAT provisions, the income is not exempt. MAT is applicable on SEZ income. So, if any profit uh, earned from the establishment in SEZ, the MAT is applicable. Hence, uh, no adjustments is required. Then provision for income tax. Provision for income tax is not allowed as deduction. It should be add back. Similarly, provision for deferred tax is also not allowed. It should be add back. Then provisions for permanent diminution in the value of investment. Permanent diminution is not allowed as deduction as per the MAT provision, so it also should be add back. Depreciation debited to the statement of profit and loss account 10 lakh. तो 10 lakh डेबिटेड है प्रॉफिट एंड लॉस अकाउंट में. So firstly we should add back this amount, then depreciation on revalue of assets to the tune of rupees 1 lakh. That means this 10 lakh is include this 1 lakh. Okay, so this 1 lakh is not allowed as deduction. Hence, we reduce uh, we reduce depreciation amount the for 9 lakh rupees. Okay, the next here is given the brought forward losses and unabsorbed depreciation as per the books of the company. It is given as per the books of the companies. Okay, so 3 years are given and brought forward losses are given. Its total comes to 12 and its total comes to 10. Okay, so we will get the deduction of this amount. Okay, so compute the book profit as per of the company as per section 115 JB of the assessment year 2019-20. So here is the computation. बुक प्रॉफिट जो हमें बुक्स में दे रखा था दैट इज़ 120 lakhs. Proposed dividend is add back. Provision for income tax is added back. Provision for deferred tax added back. Provision for permanent diminution is also not allowed as deduction, so it should be add back in the provisions. Sorry, profit. And depreciation totally we added back. Then less the depreciation, ignoring depreciation of revaluation. So 10 minus 1 is equivalent to 9 lakh is allowed, and lower of brought forward loss and unabsorbed depreciation. It should be or. Okay, so 10 is the lower amount of which we will get deduction. So we reduce the 10 and then book profit comes to 172 lakhs. Next is illustration number 8. I'll discuss this illustration because the mistake in this illustration is illustration has a mistake. Okay, let's discuss the illustration. The net profit of Renuka Limited, that is an Indian company. So as per the profit and loss account prepared as per the income tax. Here the profit and loss account is prepared as per the Income Tax Act. Okay, so profit as per income tax is 90 lakh after debiting and credited the following items. So provision for income tax. Provision for income tax is also not allowed in the income tax also, and it should be added back for the calculation of MAT. Provision for deferred tax. It is also add back for the calculation of MAT. Proposed dividend is also not allowed as deduction, so it should be added back. Depreciation, including depreciation on revaluation of assets of 20 lakhs debited to profit and loss account, that is 60 lakhs. Means 60 lakh depreciation and is debited, but the 20 lakhs of the depreciation is on revaluation of assets. That means it is not allowed as deduction. Means 60 lakhs with added back in the profit, current year profit, and reduce 40 lakhs from the current year profit. We will ignore this revaluation, depreciation on revaluation of assets. Then profit from industrial unit in SEZ area. So here no adjustment required. Provision for permanent diminution in the value of investment. It should be added back. Then compute the tax liability under section 115 JB for the assessment year 2019-20. So the computation is given. The profit as per books of accounts is 90 lakh. Provision for income tax 5 lakh is added back. Provision for deferred tax 3 lakh is again added back. Proposed dividend is also added back. Depreciation 60 lakh is added back. It is here the provision for permanent diminution in the value of investment. It should not be less than, it should be add back in the profit, because it is the provision for permanent diminution that is not allowed for the MAT provisions. So it should be add back in the profit. It should not be less than from the profit. The only we will list the depreciation amount without considering depreciation on revaluation. So only 40 lakhs should be debited from the sorry reduced from the current year profit. So when we add back this 70,000, so this amount comes to 1 crore 66 lakh 20,000, and the only amount from reduced from this amount that is 40 lakhs should be reduced. So book profit will come at to 1 crore 26 lakhs 20,000. So the computation of tax liability under section 115 JB, book profit is 1 crore 26 lakh 20,000. 18.5% of book profit is 23 lakh 34,700, and the book profit is more than 1 crore, so that the surcharge is applicable 7% because the company is Indian company. In the question it is given that the Renuka Limited is Indian company, so 7% surcharge is applicable, that is 1 lakh 63,000 1,63,429. Total of tax and surcharges 24 lakhs 98,129, and the cess 4% is 99,925, and the tax liability under section 115 JB, that is 25 lakh 98,054. Thank you for watching this video, friends. If you feel that this video is helpful to you, then please share with your friends too, and please give your feedback and suggestions for the improvement.